Hello everyone, I wish I saw this video before I started investing back in January of 2020 because, well, I made a lot of mistakes and I'm gonna fix everything in this video for you. It could have saved me so much money, so much time and so much frustration if I saw a video like this one. So please listen, open your ears and learn. Here is a list of 9 mistakes that you should absolutely avoid at all costs when you start investing. Numero uno, let's speak about fees. I know I already spoke a lot about fees on another video that I made about how to start investing, but it's a really important subject. Over a long period of time, you can actually lose a lot of money if you don't care about fees. I see this mistake all the time. Everybody start investing in the first thing that they found, and a lot of the time they have to pay fees that they don't even know about. So when you choose a broker, the first thing that you have to do is to check all the fees that they're going to charge you, because a lot of the time they're not even going to speak about that when you look at the first page of the broker, and you may be like, okay, that's a great one, but then you need to go deeper and find where you're going to lose money, because you might have some surprises. Okay, so here's a list of the fees that you should absolutely avoid. The first one being the conversion fee. Of course, if you invest into another country like I do when I invest into the US stock market, well, you don't want to have to pay a fee every single time that you convert your money into the money that you want to use. For myself, it's USD. Because of a long period of time, let's say you invest during 10 years, and every time you have to convert this money into USD, well, let's say you pay like 1% or 2%, which might not seem like a lot, but that is a lot of money over time, and then you have to convert back to your own currency when you want to withdraw your money. That's a lot of fees. So avoid conversion fees at all costs. Next is inactivity fees, but the problem with them is that they are pushing you to do some short-term investing, and as you know, if you follow me on my channel, I don't like short-term investing because I think that the market is too unpredictable for people to make money consistently over the short term, so that's why I do long-term investing. But if you have inactivity fees, it means that you are putting money into something, maybe you're not going to touch it for a few months because you invested a lot of money, and you're going to take that in a few years. So you might get charged by not doing anything with your money, and you have to check this out if you do long-term investing, which I recommend. Next is withdrawal fees. Of course, if you made profit with your investments, you don't want to take it back and you still have to pay something over it, right? And even if you don't make profit, you will still have to pay the withdrawal fees, but you already lost money and they make you pay again for withdrawing this money. That's a big no-no for me. You should absolutely avoid withdrawal fees because that can get really expensive really quick. And the last fee is about purchase and selling fee. Of course, it's the same thing with withdrawal fees, right? You don't want to pay every time you buy something and you sell something, because if you have withdrawal fees and purchase and selling fees, that's like 4 things you have to pay in order for you to put money and take it back to you. So just avoid these at all costs also. Okay, so these are the fees that you should avoid. Now, what is the next thing that you need to pay attention to? Well, it is short-term investing. As I just told you, a lot of people don't really realize that the market over a short period of time is completely unpredictable, and you can't tell in a few days if it will be up 10% or down 10%. You have all the time things that you can't really know. Like, for example, let's say the president got sick, like it happened like a few weeks ago. Well, you are not able to tell in the future what is going to happen with that, or you don't know if the stimulus bill will pass or not, and you don't know anything about the big events that can happen in the world that can change everything for a stock. Okay, now let's speak a little bit more about statistics, because I know that when I speak about short-term investing and I say that it's bad, a lot of people are like, well, I don't care, I know what I'm doing. But listen, 90% of short-term investors are losing money over the first year of trading. That's a lot of people that are losing money. You have to be on the top 10% to make money. And if you want to live off of this thing, you have to be in the top 1%. So really think about that before investing into the short term. Now, it has been shown during the whole time that the stock market was out that if you invested over a long period of time, which is 25 years or plus, you are 100% guaranteed to make money, because over time, usually what happens is that the stock price goes up. It might not happen for an individual company, but if you invest into a broad market like an index fund, this is 100% valid point. So if you invest over 25 years or plus, you are guaranteed 100% to make money. Think about that again. Now, I know quick profit might look easy, and it actually is sometimes, but it's not always the case. So pay attention to that. There's a lot of hype currently in the market with electric vehicles and a lot of things related to like cars and stuff like this. There's a lot of hype around this. And I know it might look really juicy to say, okay, they're gonna make electric cars, I'm gonna invest into them and make profit. Pay attention, because since it's a hype sector, there's a lot of new people that are starting to create companies about this that don't even know what they're talking about. Look at Nikola, for example. It's not an electric vehicle company. It is hydrogen cars, I think, but same thing, right? There's a lot of hype around this. They said that they were going to do something, they didn't, the stock crashed a lot. So you never know what's going to happen over the short term. Don't invest into hype stocks. Look at what you're investing in and pay attention to that. And also something that I saw a lot of people doing but I don't really understand is investing into companies that are going bankrupt. If you think about this, it makes absolutely no sense to do so, because a company that filed for bankruptcy means that they are going out of business. Maybe the stock price is not unlisted yet, but they will be in the future. So if you don't know what you're doing and you invest into this company thinking like, okay, they crashed a lot, they will come back a few percentage, you might be right, but the stock price might also get unlisted and you're losing all your money. So never invest into a company that's going bankrupt. That makes absolutely no sense, and even if you want quick profit, don't do it. Okay, next mistake is the one that I already spoke about in my video about how to start investing for beginners, but it is to pay off debt before investing. Because I see so many people, especially in the US, that are starting to invest when they still have, for example, student loans with really high interest or credit card debt with a lot of interest too. And well, you're not gonna make profit if you have something that's taking a lot of money on the side. The average credit card interest in the US is about 15%. The average market return, on the other hand, is about 7 to 8%. So you are losing money if you don't pay off debt at first. I know it is super frustrating to hear that, but it is so important, especially if you have student loans. Pay them before you start investing, because you're gonna lose more and more and more money every single year with interest. Now, next mistake is also something that I can understand. This one I can understand. It is waiting for a crash to start investing. If you think about it, it makes sense. You want to buy at the lowest price you can. The problem with this is that every single person that I hear saying that are always waiting and never going into the market. Why? Because they're like, okay, I'm gonna wait for the first crash. Then the stock price starts to crash. There's a big news in the market, really bad, right? And it drops 20%. And they're like, okay, now it's dropping super fast, I need to wait again. And then slowly, but it's starting to recover, right? It starts going up maybe 5%, and they're like, no, I'm gonna wait, it's gonna crash more. And then it goes up and up and up, and it goes back to where it was before, and they're like, oh no, I missed out on this opportunity. Yes, you did. So don't wait for a market crash to start investing, because you will either never start investing or you will invest at the wrong time when it's already coming back. So just invest as soon as possible. Okay, the next mistake, I see so many people also doing it, it's not having an emergency fund. It is so important, because let's say the market crashes 90%, right? It's the biggest thing that ever happened in the human history, right? And you don't have any more money. What do? Well, you can't even live right now, or you are in a deep situation that you don't want to be in. So always have around 3 to 6 months of your salary that is into a savings account. Don't invest 100% of your money into the market, because, well, you never know when the next rush is gonna be, and you might lose a lot of money on this. So as I said, 3 to 6 months of your salary that is into a savings account, ready for any time. Now, the last two mistakes that I have for you are related to each other. The first one is not to invest enough money. Because sure, I know it is scary at first to start investing, but if you already don't know how to do it and you're not really confident about it, go and check out this video about how to start investing before you do so. Now, you have to be confident when it comes to putting money into the market. I understand that. But if you put, let's say, $10 per month into the market, you're never gonna see a really big impact over your money. That's why I recommend that you put as much money as you can into the market, as long as you have your emergency fund, you have enough money to live around this. But you know, you have to make your money work for you, and if you don't put enough money into the market, well, that's not gonna make a difference at all. Like, look at me, I had a salary for 8 months that was over $4,000. Now what I do is that I put $1,000 into the market each month, and I will do so until the next 3 to 4 years, and then I will not have any more money to invest into the market. But I hope that I will be able since then to make some money on the side, so I could invest more in the future. It might sound scary to a lot of people to hear that, but you need to invest a lot of money into the market if you want to see big results. And the last mistake is actually to invest too much money, because yes, that can be a thing. I never recommend that you put all your money at once into the market. For example, I started investing in February of 2020, right before the huge market crash of the COVID. Imagine if I put all my money into the market at this time and I see it going down to 33%, I would have been so scared and I probably would have just sold all the stocks and have a loss of 33%. So you want to manage your emotions. If you invest all your money at once, this is really bad for you emotionally, right? Maybe you will have great returns, most likely you will be, but you never know what's going to happen. So I will not recommend putting too much money at once or not enough money over a long period of time. You have to find the right balance between the two, putting a lot of money but over time. Now, if you want to find the best investing strategy that I would recommend to you, go and check out this video about dividend investing and how to invest into dividends. I hope you enjoyed this video. Subscribe to the channel if you want to see more content about personal finance and investing, and I see you guys in the next one. Bye bye.